but everyone wants to know what the economic survey has to say, and the biggest number is out as far as 6.3 to 6.8% is concerned. That's the expectation of the real GDP as far as FY26 is concerned. It's in line with expectations as to what the market was working with. The street was bracing itself for the fact that the growth in FY26 is going to be below the mark of 7%. IMF was talking about a 6.5% number. Even RBI and the other NSO's first estimate were talking about a range anywhere between 6.4 to 6.6, 6.7% thereabouts. That's exactly what the estimates have come in from economic survey as well, 6.3 to 6.8%. But the good news is they're talking about there are many upsides to domestic investment, output growth and disinflation in FY26. So that's one positive comment coming in. Food inflation, which has been sticky, and usually we see at the end of the year, food inflation does become stickier. That's expected to come down in Q4. So that's the latest figure coming in as far as inflation is concerned. The slowdown that we are seeing in investment activity, that as per the CEA is only temporary in nature. Important again to mark out, because the capex in last year or the last 9 months has been on the softer side, but at least for now the assumption is this is temporary in nature. That animal spirit per se from the private capex hasn't completely died down. Maybe they were just waiting by for a bit more stability. Near-term global growth is expected to be a shade lower than the trend level. Again, something that the market has already factored in, and trade outlook might remain clouded for the next year as well. That's something that the market again has been dealing with, and that's pretty much par for the course. But the good news is that India, within all of that, has managed to see a very robust economy, and that's the reason we are still expecting the growth figure to be around 6.3 to 6.8% in FY26. Investment activity, again something which has been very, very important for markets to track, is expected to pick up. They haven't given a timeline for that. They are talking about how that is only slow down. The slowdown is temporary in nature. We do have Swaminathan Iyer, the consulting editor, with us. Hi, Mr. Iyer, thanks so much for making time and speaking with us. The GDP estimate 6.3 to 6.8%, you will say pretty much in line with what the street was expecting?
Well, 6.3 to 6.8 is quite a big range. So they are playing safe. All I can say is at this point of time, it's a peculiar situation where what Mr. Donald Trump says is affecting the markets more than what Nirmala Sitharaman is going to say. Nirmala Sitharaman, I think, was all set to do a solid budget in which she would claim victory that she had set a 5-year target of reducing the fiscal deficit, and she has achieved that with rising capex and 7% growth. Because of the shadow of Donald Trump, nobody knows what is going to happen over the next 2 years, because the guy keeps changing his mind, contradicting himself and announcing some very big things. When things are so uncertain, I'm afraid, instead of people putting saying go for the green light, everybody will be on amber. Everybody will say, take it easy, wait, be cautious. We have no idea what this madman is going to say. So I regret to say that if there is the growth is likely to be at the bottom of the spread of the economic survey, or maybe lower.
It's a bit of a challenging statement, because as it is, we had seen last quarter the number of less than 6% is something that had hit us very hard. Now you're talking about that perhaps it's going to be towards the lower end of the range. But Abik Barua also joins us on the show. He's of course been an independent economist. Abik, what's your sense? Do you also concur that there is more chance that we'll be at the lower end of the range? Or do you expect that maybe India has managed to insulate itself to a large extent? We are largely domestic driven. And in context of all of that, maybe we can manage at least 6.6 to 6.8.
I would sort of broadly tend to echo what Swami just said, that, things are very uncertain. It could sort of work in our favor if, for instance, there is a significant, geopolitical and economic realignment, which includes India, and sort of there is a diversion of activity from China. One doesn't know. But it's all very uncertain. And I think at this stage, it is prudent and pragmatic to do any kind of budgeting, be it for the government or for any company, assuming kind of, I wouldn't say the worst case, but the most conservative case. That said, let me just sort of highlight the fact that the government and the CEA have been very conservative in their budgeting. I remember during the last budget, they had a number of 6.5 to 7%, when the RBI was significantly above it. The markets were talking about 7.2% plus. So they had a 6.5 to 7% number, which is really what ultimately kind of panned out. So I think they're following a very conservative, they're taking a very conservative and pragmatic view on growth. Things are uncertain. But I think just as there are downsides, given the volatility and uncertainty that Mr. Trump's policies might bring, there are two things we need to sort of reckon with. The fact that despite domestic conditions perhaps being favorable, the private sector will tend to sort of hold back, because despite being a domestic economy, the private sector does have significant exposure to the global economy. I think we'll have to be careful about inflation going forward, given the prospect of a tariff war and tariffs across the board. So if we were to build the high probability scenario, it seems to be tilted towards the lower end of this range rather than the upper end.
A bit of a caution coming in from both our experts, talking about how it's likely to be at the lower end. But Swami sir, we have been talking about how this year the government is most likely to miss its capex target by a large extent. In the coming year, do you expect the burden to be shared both by private as well as public? Because they're talking about how the slowdown in investment is only temporary, or do you still expect the government to do the heavy lifting?
No, I think the government will attempt to keep capex up. There is no way the government can suddenly say, I'm now going to relax and the private sector is going to take over. But yes, the government, I think, has been disappointed that it has invested so much in infrastructure and there has not been sufficient response from the private sector. I will simply say, from the private sector's point of view, they are meeting the demand. And I do not think the private sector sees enough additional demand to be investing like mad, nor do they see the export scene as being so favorable that they can invest in large amounts and export everything. So in these circumstances, I can understand private sector hesitance. I mean, just as Avik said, there are so many unknowns. When there are so many unknowns, why take a chance? So the response will be conservative. And the word conservative is really just another way of saying, we're going to take it easy right now. We are going to wait and watch to see what Mr. Trump says. Because frankly, while Indian prospects may prima facie appear to have improved with the fiscal deficit coming down, the international scene is so completely uncertain. And as Abhik said, we are solidly integrated into the world economy, and what happens there matters to us. So all that we can do is cross our fingers and hope that Mr. Trump's bark is worse than his bite. Thank you.
Well, that only time will tell us. But Swami sir, does that mean that, given the fact you're talking about the uncertainty which is there, the private capex is supposed to then be lacking, or at least be on the back foot for the next 12 to 18 months as well? Do you then anticipate that capex will not hit even the 11 lakh crore mark in FY26?
I'm not an optimist at all on things like the stock market or the rupee. There are global trends. I mean, the uncertainty created by Trump means that money is going to flee from relatively risky markets to the safe haven of the USA. This means that the Indian stock market is going to fall as the foreign investors keep pulling money out. It also means that the rupee is likely to weaken further. And I do not think this process has reached its peak by now. It could go on. I don't know exactly how long it will go on, because that will depend on what exactly Mr. Trump says and does. But it can carry on for some time. So I would not be an optimist on either the strength of the markets or the strength of the rupee. At some point of time, the rupee may stabilize, but I think not immediately.
Right, so that's a bit of a caution coming in from Swami sir, but talking about the markets right now, it's Nifty as well as Nifty Bank at least holding in the shade of green and at the day's highest point when we talk right today, but definitely a big budget is awaited. Meanwhile, we also have Radhika Rao as well as Jayesh Mehta joining us. Good afternoon and thank you so much for your time. Radhika, firstly, let me have your take on the headline because both of our experts believe that it's a bit of a conservative GDP number that the government is forecasting for FY25 GDP growth seen at 6.3 to 6.8% of your range. What's your take on this?
Thank you so much. Certainly, I think economic survey, I think a couple of questions always come up when we see the economic survey. Firstly, how much of what is going to be announced tomorrow is being reflected in these numbers. And the biggest takeaway usually is which direction do they see growth going in. And I think similar to last year, we in fact think that the economic survey's numbers are, I would think, again, more conservative and more realistic. Last year, if you see, much of the expectations are around 7%. You had seen the economic survey talk about 6.5 to 7, and then it was aligning close to where the street expectations were. And this time around as well, I think that's they have done a redo, which is to bring it down to 6.3 to 6.8. We are at about 6.4 to 6.5, that range. So mid to lower part of that range. Certainly more realistic. And I think that also sets the base, of course, to where the nominal GDP will be, which again is an important takeaway for the budget, which we think is going to be at 10%. And we coming off a year when it was about 9.7%. So from that angle, I think it's right. I think what will be important to see is also what the survey says and what the government assumes as well in terms of what is going to be driving this growth. And I think that will kind of give us direction on which way the budget is going to go. Where I think it's going to be a three-pronged, consumption, investment as well as trade. They're going to emphasize in all of that. And I think subsequent comments that we have seen coming out of the economic survey seems to suggest, integrating India much more into the global value chain, certainly very important, and ways to remove remaining impediments.
All right, Radhika, thank you for that take. But meanwhile, we also have some of the other comments coming in where the government does say that the agriculture sector is expected to rebound to see a growth of 3.8% in FY25. The industrial sector is expected to grow by 6.2% in the same fiscal. And the strong growth rate in construction activities and electricity and other utility is also to be seen. But meanwhile, Jayesh, one talking point is that the government in the upcoming budget will be focusing onto how to boost the consumption. There can be some incentives around the tax cut. Other than that, the government will try to provide some more of subsidies. So help us understand that how do you see government taking steps to boost the consumption overall?
So I think we need to really do that. In that particular thing, yes, there has been a lot of talk on this unsecured loans, which has kind of baffled the thing. But even with managing the unsecured loans, we can still grow the consumption. We need to figure it out how the unsecured loan is better monitored. We right now it has kind of gone, like people talk, it's like a taboo. It's not a taboo as long as the unsecured loan is required for economic growth, and that has to be done in a more I would say more prudent way, and that's what we still need to get back to it. So rather than completely shut down on unsecured, but we can put some prudential measures, we can put higher capital adequacy, but we should not be really going down that path. So that's my first take. Because if we want domestic growth to come, that does require unsecured loans, particularly consumer loans. Secondly, I think, of course, some tax break at maybe the slab being raised to 10 lakh or something like that. That definitely is required. But more importantly, I think it's all said and done, as Swamiji also said, like we need to have our growth focus right? And therefore, the capex, and when one is expecting capex from private sector, it may take a long time because apart from seeing bank lines, they are doing some organic capex or maybe indirect capex. But I think the major burden of the capex growth has to be with the government, and that needs to ramp up. That is impacting the whole economy, which was actually driven mainly by the capex done by the government till last year, right? And I think this year we are struggling on it, and that's where we need to ramp that up big time. So I think once that comes in, everything automatically falls in place. The growth itself will, show better thing, and therefore the consumption, and therefore, so it's basically all I'm trying to say is we need to focus on growth, and the growth can come only through capex at this juncture, and at the same time easing off, becoming part of global supply chain. The China plus one, which we are talking about, we need to really, really focus more on that.
Sure. Swami said to the point that Jayesh is making, growth has to be the focus area of the budget and the heavy lifting has to be done by the government. Does that mean that it'll be okay if the government decides to step away from that 4.5% fiscal deficit target?
Yeah, I think, is this question for me?
It's for Swami sir, but in case he's unable to hear us, Swami sir, can you hear us?
Yes.
Yes, please go ahead. My question to you was whether it'll be okay if they don't stick to 4.5% with respect to the glide path.
I think that would be a mistake. I think the idea that at this point of time you should be stimulating growth. Please, when Mr. Trump is out there, this is the time to hunker down and be conservative in what you are doing. You have no idea what kind of big hit is going to come. This is not a time, in my view, to be cutting taxes on a large scale just to stimulate consumption. So, it is not as though the rest of the world is okay. And there is just a question what India does, whether we, now let us stimulate growth. We are not at that kind of point in a business cycle where you want to do that. We are, in fact, at a point where we don't know what the hell is going to happen. And Mr. Trump is going to make it very difficult to know. So I would hunker down. I would have a conservative budget. I would not be aiming for a big boost to consumption. I would be carrying on with the kind of budget they've had so far. You will have to give perhaps a few sops here and there because there is a middle class, the backbone of the BJP support, which will have to be appeased. I would go easy on that. I would say at this point, hunker down, wait and watch, because some nasty things might happen. That should be the emphasis rather than saying, hooray, things are looking good. Let's go for a big boost in consumption to accelerate growth.
All right, but Swami sir, that's exactly, I think, the government is saying, at least when it comes to the domestic market, because what they're saying is that the fundamentals of the domestic market remain robust, and they're also highlighting the fact that, Swami sir, that retail inflation will be as per the projections, and given the kind of cool off that we have seen in the commodity prices, inflation could go as per the plan. But help us understand, Swami sir, what's your reading on that? Because in the past couple of years, we have talked a lot about the inflation, be it the food inflation hitting in or the other parts of the inflation. But can inflation take a back seat and not being the talk of the town for this fiscal?
I think that inflation, again, is not entirely within our hands, nor is it the critical thing. There has been a very good harvest. The Rabi is also expected to be good. Okay, immediately the outlook for inflation is okay. But at the end of it all, what will happen internationally? Frankly, I don't know. Because of this, rather than make any kind of projections on the basis of business as usual, you would say, what is going to be business under Trump? I would just say, look, be cautious, don't jump to conclusions. Just proceed carefully saying, I don't know. To say, I don't know is better than to say inflation is going to come down.
I'm not sure whether that will, impart a lot of confidence to the stock market if the finance minister goes ahead and says, I don't know. But I completely appreciate that is the reality. Nobody knows what's likely to happen. But Abhi, come in on that. I think all of us are sounding very cautious. So let me just be a devil's advocate here. They're talking about that there are many upsides to domestic investment, output growth and disinflation. Yes, there are those uncertainties, but India has been a largely domestic economy, and that's the point I'm reiterating right now. That do you think the line that is coming in from the economic survey, where they're talking about the focus should be on MSMEs, focus should be on capital, creation and growth, that is something that the focus of the budget tomorrow is going to be most likely on?
Yes, I mean, I think that has been a sort of a constant, almost structural focus of the budget in nurturing the MSME. Often, I mean, I think there are costs to, rewarding smallness because you tend to sort of create, uh, you know, firms that don't have enough scale. But I personally think that there are potentially some upsides. And again, going back to Swami's point, that the Trump administration is not necessarily negative. As I said, that it's very uncertain at this stage, so don't expect any definitive plans or programs from the private sector, etc. And you have to hunker down. But there is a potential upside. As I said in my opening comments, that if there is a significant realignment away from China, there will be, among others, India as a major beneficiary. I personally think that instead of thinking of any kind of counter-cyclical measures on the consumption side as essentially sorts to appease, I think they should be seen as legitimate macroeconomic measures. And I think at this stage, perhaps a certain segment of the middle class and perhaps some of the lower rungs of the income ladder need a leg up. I'm not saying that we need to go gangbusters on the on fiscal expansion. I think we can still do it with some amount of capital expenditure switches. I think we've done quite a bit of capital spending in terms of government expenditure. Maybe we can pull back a little on that. And so things can be done without necessarily, being, fiscally profligate. And I would see some amount of consumption support at this stage, which presents the possibility of an upside as a legitimate, macroeconomic short-term measure. Uh, I, and I'm not suggesting that we completely forget about the public debt, but I think we need to kind of we can't have, given the constraint of the public debt, we can't have our engines firing equally on all cylinders. So we'll have to choose a cylinder, and I would at this time choose the consumption cylinder. Exports are uncertain, but given the global environment, we've done enough of public capex. Let's see what the private sector has to do. I think consumption should be a priority this time.
What way, Abhi, consumption could be spurred? Do you expect that, that trickle down impact, the way we say capex has a multiplier effect, or do you expect more revenue expenditure, more freebies and tax cuts? What is going to be that nature of spurring the consumption bit right now?
Is this for Radhika?
No, it's for you, Abhi.
Oh, sorry. No, I just wanted to, I think maybe some amount of effective tax reductions for the middle class. We have a number of templates to do that. Perhaps a little more money in the hands of the farmers, maybe Narega workers. And again, I sort of squirm at the rampant use of the word freebies. Certain measures are at times needed. Welfare measures are needed, particularly in a lower middle income economy. We cannot always classify them as freebies or SOPs. Inflation and the lingering effects of COVID have hit the middle class badly, and they still haven't recovered. So, why not? And I'm not saying sort of an across the board increase in decrease in tax rates, but at least some segments, and particularly the middle segments, I'm talking about from 10 to 25 lakhs, perhaps need support. I don't necessarily think that these are irresponsible, populist freebies. As I said, these are legitimate, macroeconomic measures.
I totally take your point, Abhi. That's what we all have been waiting for. But thank you so much. Really appreciate your time. And thank you so much for joining us today on ET Now. But with this, viewers, it's now time to slip into a very short break. Don't go anywhere. As we come right back, we will continue this discussion with all of our experts who are here with us.
Well, the market seems to be liking what the economic survey has to say because we are past the level of 23,500. A good amount of traction when it comes to the capital expenditure, industrial facing sectors, and that's the part of the market which is actually doing quite well. Of course, the proof of the pudding will be tomorrow when the budget is actually tabled. But for now, the street seems to be liking what they have to hear from the initial, sense that is coming in from the economic survey. But Mr. Sachinanand Shukla, the Group Chief Economist from L&T India, is also joining us on the show. Hi, Mr. Shukla, good to be speaking with you. What stood out to you from the economic survey so far?
I would say it's a bit of realism, and it has stuck to that. If you recall, last year also the growth numbers that they came out with were about 6.5 to 7%. This time around, they're saying 6.3 to 6.8. And mind you, this number when it came out last time around was way lower than what the RBI came out with. And I think they're persisting with realism. And also, I think I like some of the tidbits that are coming out in terms of government really basically coming out of the way in terms of business. He's quoted Ishopanishad, some shlok, Ishavasyamidam Sarvam, right? Basically, the government should leave some things behind to really enjoy the freedom that comes with it. And I hope that the cost of doing business bit is going to be followed through. Yes, I understand this may not necessarily be within the ambit of one single budget, but this is the path, the right path to really go to, and also directionally. It makes some of the right noises. It sticks to the same dose of realism. Back to you.
But in the budget as well, Jayesh, let me come to you. The government is acknowledging the fact that India continues to register the fastest growth in manufacturing PMI. Now, in the last budget itself, we have seen a lot that has been thrown upon in terms of the employment generation. Simultaneously, the government was trying to give incentive to the companies to go ahead with the manufacturing, maybe through the PLI schemes, and yet the agenda to be like China +1 is alive. My question is that in the upcoming budget, the manufacturing theme is expected to continue, and if yes, then what all the government can actually do? Can it be more on the PLI announcements, or there could be some concessional tax for the corporates that is likely?
In the panel before, right? This is not really a budget thing. Of course, you can have more PLI, but I think it's also about ease, the ease of setup, ease of doing things, right? And that's where needs to do a lot of improvement there. Hopefully now with some states are doing pretty well, and that we can see that. But I think we need to grow across. And just to get on my earlier point, when I said the government needs to spend, I'm not talking about expanding your fiscal deficit. Stick to your fiscal deficit target of 4.5. But last year, because of a lot of disruption, elections, rains, and stuff like that, we had not done enough spend on the capex on the infrastructure. And this time we have to have our head down and spend on infrastructure, government spend on infrastructure. That will help and boost almost all your MSME and everything, right? So that's where the thrust will be. And there has to be heavy lifting. There has to be heavy focus on that. And at the same time, as Abhi said, for middle class, some relief so that the consumption demand picks up. And I had also added, I'm not saying, you do Bay Farm consumer loan, but completely stopping it down, it's kind of going in that direction. We need to put more macro-prudential measures, maybe higher capital adequacy or something, but we should not completely stay away from it if the economy has to grow.
All right, that's the take. But Radhika, what is your sense in terms of what incentives can actually the government give in order to boost the manufacturing yet again? Because a lot has been spoken about how the manufacturing as a hub is to be made and how the companies are to be invited globally into India. What's your sense on that? What government can actually take steps to go ahead with?
Yes, surely. I think this is a one of those times and opportunity, where globally there is a lot of dislocation, reconfiguration that's going on in the supply chain, and of course, the investment scene in a way. Many of the countries are also competing for these commitments. But I think India stands its. I think there's many examples to show it. Offhand, especially in the past few years, where big ticket names have considered India as a very good manufacturing base, as an alternate base to China as well. I think in the budget per se, we do think that there could be, worked in this direction by way of further income tax rationalization, perhaps either by way of trimming of rates or by making it quite specific, different parts of the value chain, raw material to intermediate to final, how's the structure to make sure that duties are not inverted, and which are going to be the sectors where a lot of impetus is going to be given, especially if we are looking at electronics and wafer development and attracting more chip development names. All of this requires a cleaner structure on the import side as well. And at the same time, for manufacturing to do well, I think there's a soft infra and there's a physical infra. So physical infra, I think for the past 5-6 years, we've seen a steady increase in the allocations that have been done in this space. But I think we need to also concentrate on the soft infra to mean that when these investments do home in, they need to find the right kind of people to be deployed in these sectors. So I think what was started in the July's budget, which was like PLI to ELI, right, employment link scheme, which has been a slow to uptake for the time being, but more along those lines, and human capital, I think, will be very important as well. So we don't really see manufacturing just by way of wanting to attract investment. I think there's a demand and supply. But from India's point of view, I think rationalization of import duties is something that the budget could do, speak about from supply side to demand side, that kind of emphasis, and continue with the ELI in various forms, which is basically to make sure that the labor force is very fast and is able to, can be employable. I think that would meet most of the manufacturing sector's requirements. Certainly, what the target we had set for in terms of manufacturing as GDP, as a percentage of GDP, it hasn't really gone there. So I'm sure that's going to be one of the emphasis or focus areas for the budget.
Continuation of ELI, because that was, of course, a great step to boost employment, but at the same time, of course, taking care of the trade requirements and the tinkering there as well. That's the word coming in. Gentlemen and the lady, please hold that thought. We have to take a commercial break, but we'll be right back and continue our discussion on the economic survey and the expectations from Union Budget on the other side.
Welcome back to this special coverage on economic survey. We have already a lot of headlines pouring in, definitely from the FY26 GDP growth. That is to be seen to 6.3 to 6.8% range. The industrial sector is expected to grow at 6.2%, and the services sector growth is expected at 7.2%. A lot of these headlines made, but the key factor that will be in focus tomorrow is how the government will go ahead and boost the consumption overall. What major announcements can we expect on the capex front as well? But Swami said, in the meanwhile, what the economic survey is also highlighting and acknowledging the fact that the investor activity is seen to be slowing down a bit. Yes, we have talked a lot about the rupee depreciation and how these foreign investors outflow is what we are seeing right now. And you were also highlighting that you're not that optimistic onto the markets. But now there were some hopes that the government will acknowledge this particular fact and maybe some good announcements were expected. But what's your take that now that the government is also saying that the investor confidence is seen to be shaking a bit, how do you see this?
I would say at this particular point, I'm afraid people are more interested in what Mr. Trump is going to say than what Nirmala Sitharaman is going to say. So yes, India's fundamentals are looking pretty good. But when you have a situation where you have no idea what Mr. Trump is going to do, what impact that is going to, most people will say, take it easy, wait and watch, hunker down. Don't be the certainties on the basis of which investments have taken place, that has been seriously affected by Mr. Trump and is going to continue. So as far as, it is just as well if the government says, let me take measures to make business easier. That is fine, something you've been doing and you keep going on that. But if you want to go beyond that, should you be stimulating consumption? And I said, that's a bad idea. Consumption is going to improve anyway because of a very good monsoon. The rural demand will go up. But if the budget says, let me focus on raising consumption rather than the fiscal deficit, I would say no. Stick to the fiscal deficit. On consumption, you need to be conservative and wait and see what is going to happen to the world economy. I don't think this is the point at which you say, this is the point where, that is the focus of the budget. I don't think so. Things are difficult, things are uncertain. Don't present budget with fireworks and patakas. Please have a conservative budget, hunkering down.
Hunker down. That's the message, clear message coming in from Swami sir. But Sajid Chinoy also joins us on the show. He's, of course, the India chief economist joining us from JP Morgan. Sajid, hi, good to be speaking with you. Well, I'm really interested by the chapter names the CA has given to the economic survey this time around. Medium-term outlook, deregulation drives growth. Industry, all about business reform. Services, new challenges for the old horse, as well as agriculture and food management, sector of the future. And also, of course, the AI one, and the biggest one that they're talking about, labor in the AI era, crisis or catalyst. So a lot of important discussion points there. But I'm interested in the 2 points, deregulation as well as the fact that agriculture and food management, they're calling it the sector of the future. Do you expect some big bang announcements perhaps for the agriculture sector then, Sajid?
I think it's important to lay the macro backdrop here. I want to just pick up from where Swami left off that, we're seeing unprecedented global uncertainty here. And, given that uncertainty actually, I would argue, even predated President Trump, that it was really US exceptionalism in 2024. The fact that US growth was so strong, the last mile of disinflation was challenging. The Fed is hardly going to cut rates this year. That's what made the global picture much more challenging because the dollar strengthened to nearly 20-year highs and global rates remain elevated. So I think the policy challenge in 2025 is a unique one where we've seen a domestic growth slowdown. And the question is, how does policy respond to that domestic slowdown without appearing to let its guard down against a very hostile global environment? And getting that balance right will be important, number one. The second challenge in my mind is, we are on a fiscal consolidation path. I think that's important because with nominal GDP in the high single digits, we've seen debt begun to move up. So deficits will have to come down. But I think calibrating the pace of fiscal consolidation is important. So the question is, if deficits have to come down, there are limited degrees of freedom that policymakers will have to inject a stimulus, because if you're injecting a stimulus somewhere in another sector, you'll have to make up for that, right? So either revenues have to go up in the aggregate or expenditures have to come down if deficits have to come down. I think the last point to your question, I think the deregulation part is really important from a medium-term perspective because we have to realize the limits to public investment and the government's role in the economy. I think we're reaching the point where both fiscal constraints and absorptive capacity constraints will mean public investment will face some ceilings. Now, as that retreats, the private sector will have to fill that space. It's going to take time, A, because of a lot of global uncertainty, B, because arguably the private sector needs more demand visibility. Capacity utilization has been around 75% for a long time. You perhaps need a higher level of utilization rates given the excess capacity in China to commit to investments. But I think animal spirits matter. Animal spirits matter. And I know the global environment is hostile. So to the extent that the government can keep deregulating, making it easier for businesses to operate, hopefully the accumulation of those measures will trigger animal spirits at some point. As I keep saying, given the fiscal constraints, the budget doesn't have space for a fiscal stimulus. What we need is a reform stimulus to try and resuscitate animal spirits in the private sector.
Reform stimulus, it's a very, very thin rope that the finance minister has to walk. You guys laid out very clearly the kind of challenges that lie ahead, and it's a very nuanced challenge this year, as Sajid put it. But thanks, gentlemen, for joining us today and helping us decode what the economic survey is trying to focus on, and more importantly, what perhaps the focus of the budget tomorrow is going to be. With that, we'll wrap our special coverage as far as the economic survey is concerned. But stay tuned to ET Now if you want to hear more about what is the expectation from the budget and how is the market likely to react to that.
If you like this video, then like, share and subscribe to ET Now.